But Mike, let me kick it off with you. We've got a rally, kind of a continuation, if you will, of that positive momentum that we saw yesterday.
Right, and I think that's the key word there, as you said, momentum. Yes, the economic data was decent, not really blowing anybody out of the water. Decent economic data, but really it's just that funky time of year. I mean, I hate to say it,
funky?
but it's the funkiest time of the most wonderful and funkiest time of the year in the stock market. I hate to even say this, it sounds so ridiculous, but there is something to this notion of the Santa Claus rally. And people debate what the reason is. You know, the traditional reason you read in the Stock Trader's Almanac is, well, people just get in a buying kind of mood this time of year, but you have your year-end bonuses, you have active fund managers trying to show some performance. All sorts of things sort of conspire to cause this end-of-year strength. Now, it doesn't necessarily look like January or December will be as strong as it normally is, but we're still getting this bump at the end of the month here. One really fascinating thing, I saw a research report out from Barini Associates yesterday, and they talked about Monday was an especially funky day in the market. Opened very strong, triple-digit gains in the Dow. Then it sort of faded, and not really a lot of news to push it or pull it either way. Then we had a really strong rally right at the end. And as Barini pointed out, that day was the payable date for dividends and capital gains on index funds. And so much of the money in recent years has flooded into passively managed index funds that just track the market.
Right.
And that's the day when their dividends were paid. What happens to the dividends? Well, they're reinvested in the fund and in the stocks.
So the money goes back in.
And the money goes back in. So an amazing little technical thing that could cause a rally like that. And I guess a lot of people probably know that's happening, see it coming, and get ahead of it. And it's amazingly one of those just funny quirks of the market that you would think would be more predictable. But you know, here we are, still sort of surprised by it.
S&P though still down about 1.33% here though for the month of December. So we'll see what else happens in the next week and a half or so. Hey, Drew Redding, Bloomberg Intelligence. I know you cover the housing area for us, and we did get, as I mentioned, a ton of economic news today. We did get some data on new home sales. Break it down for us.
So in general, the housing market continues on its steady path forward, at least from a demand perspective. The underlying fundamentals of the market haven't changed much of late. Job growth remains strong. Rates are still low. Lending is still somewhat restricted, though improving. Volumes are expected to rise about 4% in the resale market and about 11% in the new home market. Now, when you're talking about the strength of the markets, it's important to distinguish between the broader quote-unquote housing market and the home building market, because the builders have to deal with some challenges that the existing market doesn't, and that's mainly the supply chain.
Well, that's a good point. I mean, Drew, in general, you know the housing market really well. I mean, we care more about existing home sales and the activity we're seeing there. That's a bigger part of the housing pie.
Right. So the existing market's about 90% of total U.S. home sales, from its historic norm of about 85%. As far as economic growth is concerned, new residential construction, both single-family and multifamily, is extremely important for the economy.
Because it tells you what about, why is that so key in terms of an indicator of what's going on more broadly?
Well, for one, the new home market and the related construction is what creates jobs. So for every new single-family home that's constructed, you're creating about 3 jobs, and for a multifamily unit, you're creating about 1 job. So putting more jobs into the economy is, one of the areas how housing really drives things.
Right. So there's a bit of a trickle down. Mike, go ahead.
Drew, I was going to ask, do you expect to see sort of a flurry of purchases as people realize rates are going up? I mean, how do you sort of gauge what is natural strength in the housing market and what is people trying to, finally get off the fence and buy something, worried about potentially higher mortgage rates next year?
Right. It's difficult to say. And in previous periods where we've seen increases in rates, there's really no hard evidence that it pulls people off the fence. Now, this time is different because this is the first time the Fed is actually making a move. So it's possible you'll see that. I think, as far as rates are concerned, in the near term, I wouldn't expect a major impact on housing. The problem comes as rates continue to rise, and it's more of a cumulative effect throughout the year. And really, it all comes down to affordability. So if home prices continue to rise, let's say a modest 3% increase in 2016, and rates increase to about 4.5%, affordability falls back to 2008 levels. And given the way that consumers likely digest increases in monthly costs, that could become a bigger concern going forward.